Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, December 13th, 2024. The argument for the Fed to make another cut to its policy rate when it meets next week just got a little weaker. On Wednesday, we learned that the Consumer Price Index for all urban consumers rose 0.3% in November and grew 2.7% over the past year. Now, excluding food and energy, core CPI increased by 0.3% in November and gained 3.3% over the past 12 months. That was the fourth consecutive month that core CPI grew by 0.3% and is higher than the monthly growth rates in the 3 months that preceded it. So here's that report. Now here's the little snapshot just for the month of November. Everything looks pretty normal, about what was expected. When we look at the summary, and over here on the far right are the 12-month figures, and then next to that are the November figures. And if you come over here to less food and energy, where I have the cursor, you see the 3.3% 12-month figure. You see over here to the left of that the 0.3. Keep going to the left. It was 0.3% in November, the same in October, September, August. It was only 0.2% in July. It was only 0.1% in June, and again 0.2% in May. So the trend is not down. Obviously, the trend is up, granted, moderately, but nevertheless, the trend is up and not down. That's just apparent from looking at it. So that trend suggests inflation has stalled out at an annual growth rate of around 3%, depending if you want to blend the core and headline numbers and all that, but let's call it 3%. That's higher than the Fed's target growth rate of 2%. So another policy rate reduction next week won't help accomplish the objective of bringing down inflation. And neither will yesterday's Producer Price Index report for November, which included a 0.4% rise in wholesale prices last month. And that's higher than the 0.3% increase recorded in October, which was higher than the 0.2% gain in September. So again, go out here to the far right column. That's the 12-month change. Now we come over here and we look at the final demand on a monthly basis. And here they do it a little differently. So November's down here at the bottom, and then it goes up in terms of months. So it's a little different than the chart we just looked at. So down here in the bottom where I have the cursor, 3.0% 12-month change in final demand. It was 2.6% in October, 2% in September. So clearly that number is going up and not down. Okay? So whether you look at the monthly number or the trailing 12-month figure, all the numbers are going slightly up in terms of consumer prices and producer prices. So the trend we're looking at here with producer prices suggests that retail prices must go up by at least that amount for everyone along the supply chain to maintain their respective profit margins. Combined, the CPI and PPI reports for last month paint a picture of an economy that is heating up, not one that is cooling down. That is why the stock market keeps climbing higher. It is not artificially low interest rate that Wall Street really wants to see. The central bank monetary policy is a crutch to get through difficult times, which is why Wall Street would rather see corporate profits rising at a steady rate as the economy steadily expands. And so far, Wall Street is getting what it wants. But it'll be interesting to see how it reacts to next week's policy rate decision by the Fed. Right now, almost everyone is expecting a 1/4 percentage point reduction to the policy rate next week. If that happens, then I would expect Fed Chair Jerome Powell to make clear in his comments in the press conference afterwards that the dot plot for 2025 and 2026 could end up looking quite different from what was anticipated a few months ago. But if the Fed decides to keep its policy rate where it is next week, then Wall Street might panic over the insinuation that inflation has reignited. Now, I don't think that outcome is likely, so I wouldn't get too nervous about what might happen next week as far as that goes. In fact, I don't see anything on the horizon to trigger a stock market correction this month. It isn't until we get into January that we could hit a stumbling block as fears of import tariffs and how companies address that in their guidance for 2025 take center stage. That's this week's PF Video Update, and I look forward to talking to you in another week.